Hi, good afternoon. You're watching Closing Trades right here in ET now, and it's not looking all that bad, really, especially given the hangover that we had from the rest of the globe. The spike on the bond yield all the way to that 5% mark. So given that context, we've really been resilient, and I use the word resilience because we've not really dipped sub the 19,500 mark. We've managed to hold out in trade. It's actually Kotak Bank ahead of its numbers, which is actually holding out in the green. There's of course Nestle too reacting to its numbers, HDFC Bank, ICICI Bank. So as surprising as it may be, it's the big boys from the private banks which are actually comforting the Nifty as we speak right now. 0.5% higher for HDFC Bank as we speak right now. And remember, some of these stocks like an HDFC Bank and Kotak have been ranked underperformers, so to speak. So yes, private lenders, they're failing, they're faring better definitely. You're seeing good earnings momentum come by for a JSL, that's Jindal Stainless, UBL, Tanla Solutions. These are all stocks which are holding out after a good set of numbers. Weak commentary and weak numbers though coming in from Emphasis, Havells, Century Textiles, and all those stocks are reeling under pressure as we speak right now. A lot of other stocks also which are in focus. There's NMDC Chhattisgarh plant, which is not going to be privatized. So that's one stock which is in focus. And then, of course, there's IGL as well, wherein the aggregator policy is now mandating EVs approved by the Delhi Chief Minister. So that is one stock which is in focus. And that's sharply lower by about almost 12% as we speak. The policy, as we understand, will be entailing faster adoption of EVs in Delhi, which is why some of these gas plays are the ones which are tanking in trade. There's also Sigachi. The stock is up a good 9% right now. It's the highest it's shot up in about 5 weeks' time. So they've formed a joint venture with Saudi National Projects, and they're going to be setting up a facility in Riyadh in about 3 years' time. So that is one stock which is holding up in trade. But since we're on the subject of IGL, let me quickly take it across to Somit and try and understand a little bit better as to what's going to be the impact on IGL with this aggregator policy, which is mandating a faster adoption of EVs in the national capital. Somit?
Well, if you see, to simply put, it's the future growth that has come at risk for IGL, and that's the reason why we are seeing such kind of a downfall in the share price of the company. Now, the aggregator policy mandating electric vehicles has been approved by the government, and it has been sent to governor for its approval. Once it's approved, it has to be implemented in the next 90 days. Now, what does the policy say? It says that in the next 6 months, any incremental vehicles coming in from Ola or Uber's side needs to be at least 5% of the same needs to be electric vehicles. In the next 3 years, in post 3 years, nearly 50% of the incremental vehicles need to be electric vehicles, and in post 5 years, all the vehicles that are coming in on the street, all the new vehicles coming in on the street need to be electric vehicle. Now, this puts the future growth of future volume growth of CNG at risk for IGL, and that is the biggest reason. That is the only reason why the share prices are down. Now, if you see IGL's taxi share of CNG volumes form nearly 15 to 18%, and if you include the delivery vehicles also, as per Jefferies, nearly 30% of the volume that IGL sells are to these three parties, that is Ola, Uber, taxi aggregators, and for delivery vehicles. So that comes at risk for IGL going forward. Now, Jefferies, which also downgraded its rating on IGL, is saying that IGL is already facing problems when it comes to the bus volumes, because most of the new buses that are coming on the street are electric vehicles. Also, three-wheelers that are coming on the street are electric vehicles, because the pricing economics is in favor when it comes to electric vehicles as compared to CNG three-wheelers, and hence these two sections were already at risk. And going forward, now the cab volumes will also be at risk, and hence we are seeing such kind of a fall in the share prices of IGL. Now, they also believe that the growth, that incremental growth that will come in from the newer geographical areas won't be able to compensate for these losses, and hence we are seeing such kind of a fall in the share prices of IGL in trade today.
Mantesh also joins us now. Let's connect with him. Mantesh, this market is getting rusty, technicals are getting sticky, and global cues are now not looking all that solid and strong. Do you think the best part of the market for next couple of weeks and months is actually behind us?
Yeah, I think so, because you have seen a lot of volatility in the market. Markets have been rising up, going down, partly due to a lot of geopolitical tensions coming in, due to results flowing in, and a little bit on uncertainty related to the US Fed policy as well. So all these events compressed together have come about in the past 4 to 6 odd weeks, and of course, huge volatility in the market. With the net market trend lowering, I guess now the future ahead seems to suggest that we can look for a better market days ahead.
Kunal, we've not done anything for the entire week now. I would say actually for last 2 weeks now.
Yeah, Nikunj, in fact, you can probably extend this to the entire month.
Ek mahina se?
Yeah, this is the entire. So 25th of September, we were at 19,650.
27 September, which is 1 month ago, we were at
19,650.
Abhi bhi wahi hai.
19,550. So 100 points plus minus is the broad.
And what's happened to small and mid cap during that time?
All-time high for sure.
No, the mid-cap index is also flat. In fact, mid-cap is slightly lower. 26 September, mid-caps were at 11,400, 11,600. Today we are at 11,350.
And small cap?
Didn't small caps hit an all-time high, the index?
In between, it may have hit a small
Yeah.
all-time high.
Yeah.
So bottom line, we are jumping in the same place for last 1 month. So much so for so much of analysis and so much of commentary, right?
Should we take the next month off now? Are we going to stand here only?
No, I don't think that it's going to extrapolate for so long. But I think it's a good sign that the markets have digested so much of news flow,
Without doing
geopolitical,
nothing. Yeah.
TCS result, Infosys result, and then all the other banking names, etc. So I think it's a very mature sign from the market that we are not buckling under the pressure as such, which has been handed over from the global markets, not just geopolitical, even with the news flow across the US and what's happened to the US bond deal. If you look at the index, 0.5% down for Nifty and plus for the bank Nifty, that would be taken with both hands any day.
Okay.
Okay. The interesting trend today is Kotak, ICICI Bank, both are holding out ahead of their numbers. The numbers, of course, are tomorrow. We're only going to react to on Monday morning. But Kotak is significantly higher, actually, about 1.5%. Naresh, do you finally see these sleepy giants picking up, or is it too early to say that?
So, too early to say that. If we look at Kotak Bank over the last, say, back in August, it made a bottom around 1760 levels. In September, it corrected down closer to 1700. And for the last almost a week or 2 weeks, it has been in the range of, say, 1780 on the higher side and roughly 1710, 1720 on the lower side. So, it's been in the range of 50 to 80 points. So, if we start crossing 1800, post numbers, that would be our first indication that there is some bit of a trend reversal. And if we go a little longer, for the last almost, say, 3 years, say from November of 2020, the stock has made bottoms around 1650 and tops around 2000 for most of the times. So it's been a range bound on a 2-week basis as well as 2 to 3 year basis. So too early to call.
Okay, since we've got these two earnings lined up tomorrow, let me take it across to Harsh and find out what the ET Now poll is penciling in. We will get him in just a second from now. But yes, you'll have ICICI Bank, Kotak Mahindra Bank, both of them deliver their numbers tomorrow. And even though it's a truncated week with 22nd or rather 23rd being an off, or 24th actually, right?
24th.
What is Tuesday? Yeah. Okay. 24th being a trading holiday. You've got 25th, you've got Axis Bank, you've got Tech Mahindra come out with its numbers. Then, of course, you've got Asian Paints as well. And then, a slew of other numbers. You've got Cipla, you've got Maruti, SBI Life, DRL, Bajaj Finance, all of these slated to come out with their numbers next week. That, of course, is the earnings calendar. Of course, shortly we will get in Harsh to highlight what to anticipate from both Kotak as well as ICICI Bank. But Mantesh, we're awaiting ICICI Bank as well as Kotak's earnings performance, but suffice to say that the leadership stands with ICICI Bank amidst, of course, the private banking names?
Yeah, I think so. You can see that very clearly in the stock performance over the past year or so. Why year? Even if it could take a longer horizon of a 3-year period, then ICICI Bank seems to have stood out relative to the other private sector banks. And there's a reason for it. The reason being, I have mentioned also before that corporate banking is looking relatively better to personal banking. And ICICI has done quite a bit of effort on the corporate banking side. Generally speaking, the market views HDFC Bank as a personal banking kind of giant. They view at Kotak Bank as on the essentially focused on a lot of non or co-banking related kind of activities, whereas ICICI Bank is something which is kind of mixed. It is leaning towards the corporate banking side more relative to any other bank that I've just talked about. So yeah, it has been doing well, and I guess that going ahead, corporate banking will continue to be favorable part of the business for the banking sector as a whole.
Okay, in fact, here's an exclusive interaction with HDFC Bank's commercial and rural banking chief, Rahul Shyam Shukla, who says that they expect 25 to 30% growth in this particular segment and pre-tax ROA of over 3%. Here's him in conversation with my colleague Ankur Mishra.
The guidance we always give is that, look, you should expect 25 to 30% growth rate. You should also expect a ROA, pre-tax ROA of greater than 3%. And that's a pretty healthy number.
In this particular division.
In this particular division. And that is what, me and my team continue to work day in and day out, because as we expand our footprint, which is the reason for our success, and the reason that we continue to basically showcase the growth rate and customer additions, that is important, and to maintain that particular growth rate or ROA is a pretty satisfying number from bank's perspective.
Once this kind of growth happens, as you were also mentioning, the questions are asked, and how good is the portfolio, how are you taking care, what are the underwriting practices. First, I want to understand that how much is NPA in this particular portfolio, the average one, and also the underwriting practices, because I know it is important to keep checks and balances as well. It cannot be at the cost of growth.
Right. So I've always stated that, if you think about SME business, your GNPA should be ballpark around the 1%, number.
Okay.
Now, this is where we are. And if you think about, basically the overall banking system, nationalized banking system, private sector banking system, it is significantly higher, and you can get the data from Bureau, but this is where we are. And the second thing is that on the agricultural lending, I think this is a higher NPA segment, because it goes through even the weather pattern considerations, hailstorms,
right.
Rains, less rains, more rains, floods, etc. I think if you are maintaining a GNPA somewhere between 4 to 5% and you've priced it correctly, your lending, and then you are all right, because banking is not just about NPA. The yield that you have, your cost of funds, so you get a net interest margin, and you have a cost of credit, and when you take that out, that is what leads into ROA. So we drive business along the ROA number, and to try and basically keep it at the levels that we just discussed. I think it's a pretty healthy way of doing business.
So it is definitely going to at least help in improving margins, at least this division.
Of course. I think because our overall margins are good, and I think that is accretive for the bank, and that is how we intend to continue doing business. Let me also tell you about the portfolio quality. During COVID, Ankur, we were the largest lenders in ECLGS. There was a lot of noise at that point of time that banks are doing window dressing and all that.
Right.
We took it the other way. Today, because of all the reforms that have happened, done by the government, GST, etc., I think for a promoter to go out and get collateral, for taking more lending becomes very difficult, right? At that point of time, when you think about ECLGS, 30%, you were giving 30% additional credit. And when you look back as ECLGS, basically runs off, our NPA numbers on ECLGS or non-ECLGS is no different.
Back with closing trades right here in ET now, holding out okay, still clinging on to 19,500 mark. Private banks along with some odd names like a TCS, Nestle are the ones which are comforting the Nifty. Even Bajaj Auto, after that big move of 6% in the stock yesterday, today it's not fallen unlike the other large caps. It's fairly resilient, and it spent the better part of today's trading session with quiet to marginal gains. MCX, of course, that's the big mover today, a 4% uptick on that stock. UBL holding out 2.5%, even though the numbers didn't match up to the street estimates. Muthoot Finance, Berger Paints, Z, these are some of the buzzers out there. But what about Kotak and ICICI Bank? What to pencil in from their numbers? What to expect? Harsh is here to tell us all about that.
Well, let me start off with Kotak. 6,300 is where the 6,300 crore is where the NII is expected to be at, a solid 24% jump on a year-on-year basis. You're also expecting operating profit to come in at around 4,500 odd crore, which is a rough 26% again growth on a year-on-year basis. The focus here on the top line will be largely on margins as well as on OPEX. Margins, you're expecting some bit of decline to come through for Kotak. Provisioning is expected to be largely flat sequentially. 400 crore odd is where the provisioning number is expected to come in at. Profit after tax expected at around 3,100 crore, which is a 20% year-on-year growth as well. So a healthy standalone set is what we are expecting. In terms of NPAs, you are expecting largely flat asset quality. NPA wise, your NPA ratios will be flat. Advances expected up a solid 16%. Deposits expected up 23%. So that deposit growth engine expected to kick in quite sharply in this particular quarter. In terms of credit cost environment, expected to remain benign. Some commentary on unsecured will be expected. Steady, healthy growth on both sides of the balance sheet is expected. Keep an eye out on margins and expectations on margins. Quickly moving on to ICICI Bank. Largely, ICICI Bank also expected to maintain margins. In fact, margins will come off for ICICI. Beg your pardon, not maintain margins. NII expected up 25% year over year. 18,500 odd crore is where that NII is expected to come in at. Operating profit expected to grow 20% year over year. 14,000 crore odd, flat sequentially. You're looking at provisions which are expected at around the 1,300 crore mark, and you're expecting profit after tax again flat sequentially around the 9,500 crore mark. NPA ratios expected flat. Advances growth expected at 17% year over year. Deposit growth at 16%. Some commentary on how deposit growth will shape up over the next few quarters will be expected. Margin contraction by how much? Some commentary around that will also be expected. And how is credit growth really shaping up? And how is unsecured really getting placed is what the key commentary will be for ICICI as well.
Okay, that's the take coming in on what to expect from some of these private banking names. Just looking at the texture of the market, and Mantesh must discuss the performance from Bajaj Auto. While year to date and even the year before that, it's always been TVS which has actually won the cards. But do you think now the risk reward is favoring Bajaj Auto more so after the Q2 performance?
The Q2 performance was indeed very good, but then Bajaj Auto is dependent a lot on exports and export markets for its revenues and profitability. Much of it is also dependent on their exports to the African continent, with a big chunk also within that coming from Egypt. And now, with the tensions that are created right now in the past week or so, is not something which is good news for Bajaj as far as Bajaj is concerned. And I'll be a little worried about the progress ahead. So while the growth to profitability has been good, it could be mired at least for 1 quarter or so is my expectation.
Mantesh, we had an interaction with the management of IndusInd Bank in the morning, and we've come back with the following: that growth will be 20%, cost of capital would start coming down, ROA would be 2% plus, and the stock is trading at a price to book of 2. Does it make sense now to say, okay, HDFC Bank is not headed anywhere, it's time to look outside the comfort of HDFC Bank?
Yeah, one should really look at the outside the comfort of HDFC Bank, simply because of the overall banking trend seem to suggest now that we are going to enter a phase where interest rates are peaking out. They've actually peaked out rather, because the RBI has not taken any repo rate increases for several months now. That said, what really happens is, as the interest rates to keep falling, the noticeable trend is obviously the margins compress. But with that, there is a kicker that comes in the form of volume growth, given that we have overall macroeconomic stability. So therefore, most of these banks are talking about a growth upwards of 20. Some are even talking about 25% kind of band in terms of their growth rate. So between the NIM compression and the volume trend in terms of advances growth, the latter would fairly compensate the NIM compression trend. And my expectation is that the growth will be so strong that when it comes to the OPEX and profitability arising out of that, can give a boost to the ROEs. So from a forward-looking perspective, most of the banks should be looked at a significant premium over the RO in terms of multiples that we offer to the book value. So yes, IndusInd Bank is one such bank which is doing incrementally better, while HDFC Bank is not. So the reason why you picked and why I tend to agree that this could be the case is because of the ROA trend. But let me say it this way, that we're not going to see HDFC Bank or the other banks actually fall off substantially from where they are in terms of stock prices. It's all about the premium that gets attached, or the expansion of premium over the ROA numbers in terms of price to book value multiple.
Right. Okay. In fact, on the subject, here's Nikunj's exclusive conversation just this morning with Sumant Katpalia from IndusInd Bank.
In a very difficult macro and the world macro, I think India, it continues to outshine, and I believe it's just started. I think the next decade belongs to India, and I'm completely convinced that whatever our regulators and the ministry is doing will only fuel the growth in the Indian economy.
Let's talk about specifics of IndusInd Bank. If I take the clock back, let's say 5-6 quarters ago, IndusInd Bank was growing in mid-teens. Now you're growing in early 20s, much higher than the industry average. You're growing without raising capital. Your CASA is in place. So can I say that now the bank is firing full cylinders?
I think you have to see our growth and where the growth is coming from. I think we have domain specializations. So our two domains actually got subdued during the COVID crisis, which is the vehicle finance as well as the microfinance. And we were very conservative on that. I think they've come back with a very strong presence. And over a period of time, we've also diversified that book. So we are not now dependent on one asset to give us the business. There are 8 categories of vehicles. For example, car loans is 25% of that portfolio now in the vehicle category. If you look at microfinance, we're not dependent on JLG. 15% of the book comes from merchant acquiring business. So we've started to diversifying that businesses so that the cyclicality of that business continues to go off. On the diamond side, we've seen a reduction because the diamond industry is in a stress. So we do working capital. The book has reduced by 10 to 12%, and we are fine with it. So I think as long as we are in the businesses which are seeing growth, I think we are seeing growth. We've added new boosters to our growth. Mortgage businesses have come in. Affordable housing has come in. I think our consumer bank business is started firing on all cylinders, growing at 35 to 40%. So we've got a very good momentum in place, and I believe the bank can grow at the rate of 18 to 23% on a compounding basis.
And you see this kind of invisibility for 3 years or beyond 3 years?
So we always make a plan. We've made a plan for PC6, which is a 3-year plan. We believe that we should be growing at 18 to 23%. And in the first year, we're growing at 21%. So we are on the right side of the growth rather than on the left side of the growth.
And you see you could remain on the right side of the growth for next couple of years? Because
I think
18
so.
to 25, sir, there is a delta of 5%.
18 to 23,
18 to
and
23.
You're absolutely right. And I think we believe that with the type of domains which we have and the investments which we've done in our business, our growth should be upward of 20% on a compounding basis.
Okay, and Adani Cement has refinanced its $3.5 billion worth of debt, which it had taken for acquiring Ambuja Cements and ACC. Now, the company, through Endeavour Trade and Investment, has entered into a definitive agreement for a fresh facility from 10 international banks with maturity of up to about 3 years, the company said in a statement. In fact, Adani Cement, remember, is the second largest cement player in the country with $6.6 billion acquisition of Ambuja and ACC, the largest acquisition in infrastructure and materials sector that concluded on September 22nd. The $3.5 billion facility marks the continued execution of the capital management plan outlined in September 2022 that will see stepwise planned deleveraging of Adani Cement, and that's what the conglomerate has said in a press release. So that's another group of stocks which are in focus. In the meantime, let's get in some closing ideas as well. Kunal, let's start off with your list.
Well, I'll go with Dixon Tech as a closing idea. The stock looks attractive, perched at a fresh weekly high for itself, and the momentum has been very stable for the stock price. I think that's a standout feature for the stock, so we'll look to carry positions over here.
Okay. And Naresh, what about your closing ideas?
So that would be a buy on IndusInd Bank, testing that 1470-75 mark, which was the recent swing high as well as a 52-week high, and has been showing a lot of resilience over the last 1 week or so. So looks like it could break out going forward.
I'm just looking at Laurus Labs numbers. While the top line looks like, pretty much par for the course, and there also it's seen a dip. It seems like there is a one-time adjustment because I don't think the PAT can slip 84%. Clearly
Must
seems
be,
like a one-time loss.
So Aisha, either they've had a provisioning or there was something extraordinary same time last year, which I'm not aware of. What I understand from Laurus, and again I'm just jogging my memory here, that when they came out they did say that the worst is behind them, and for last quarter also the numbers weren't exactly great. Now this is one stock where you can, the marquee investors are here in this, guys. I mean, you look at the shareholding list and you'll figure out, where some of the marquee names are. And that's the problem with the pharma companies now. What they indicate versus what they deliver sometimes is just not matching up. 84% down for the PAT. I'll look at the numbers in a second and then we'll be able to give you a very objective view. But so far the market reaction seems to be like, okay, we knew this was coming. I'm not on top of this. I don't want to comment on it. But revenue is down 22%. If revenue is down 22%, there has to be pricing power or maybe some product launches which have gone here and there. But if PAT is down, that means they've either taken some write-off or there is a forex or there is a goodwill impairment or something, which I'm not sure. Let's see the numbers when they come out. We'll try and get the numbers ASAP. But meanwhile, the market reaction has not been there. Kunal, time and again, we've discussed Laurus ka samay aayega. I think we extensively discussed it 3-4 months ago. It went from 360 to 415, 420, and then it has fizzled out.
Yeah, it's fizzled out, and but the charts are not weakened significantly in the last 1 month of this correction for Laurus Labs. So the stock has done. I look at it from the March lows, where from sub 300 levels the stock went up to as much as 400, and now it's trying to get into a time-wise correction. Even this time-wise correction, the volumes have been apparently much better for Laurus Lab. Unlike the volumes when the stock was actually going through that sharp drubbing previous year, I think if I'm not wrong, from 600, 650 levels to sub 300 levels. So which means that the stock is now trying to stabilize at a higher support zone. So I think that's also considered to be a good sign. We generally don't expect V-shaped recoveries into such stocks, but even if they can lift off their supports and spend some time at a higher support for say 6 months or so, that would generally be considered as a good sign. And I would probably consider that that's the pattern for Laurus Labs.
Okay, that's the take coming in on Laurus Labs. In the meantime, Mahantesh, we'll let you go. Thanks as always for taking the time out. We'll slip into a quick break. But here out from Tata Communications, Havells and Emphasis managements post their numbers.
We continue to invest in our products. We have acquired Switch, where I said the integration, the teams are doing an excellent job. And Kalera, we have had an accelerated closure, and we will be integrating that. So, we will put our heads down, make sure now the execution is sharp. And whenever the market is ready, we will be prepared, is what I can say. So I don't want to read out and look out for the H2, how it would be. But, overall, we think we would still do a double-digit growth. And with the inorganic coming in, our growth would be faster than that.
Lloyd's journey will continue to invest in brand building there and manufacturing and R&D. The second quarter, because of low sales for air conditioners, because of the season, that generally is the lowest in terms of margins as well. In the third, fourth quarter, when the demand starts picking up, we'll see expansion in margins in Lloyd. Hence, from next year onwards, we should see a much better margin profile for Lloyd.
I think the wins have been fairly broad-based across verticals. They're not led by any one vertical. Non-BFS, both in terms of pipeline, has expanded very significantly, over 50%. Even BFS pipeline is up 25-26% YOY. Wins-wise, I think there's a pretty equal distribution, both in terms of Q1 and Q2. So I think it's a pretty broad-based view of both the pipeline as well as the TCV wins, and we're very pleased with the fact that while we're not deprioritizing BFS at all, because that's our home vertical, we have a right to win there. We continue to actually make sure that the diversification outside of that gives us new engines of growth, and that execution strategy has been working very well for the last few quarters.
Now, why are Loris numbers down? Why are they down? And if they're down, then why is the stock not down, which is markets were expecting it? So what is the mystery here in the 84% drop number? Let's understand that. Shrishti done a breakup and she's going to tell our viewers. Shrishti.
So the Loris Lab Q2 FY24 earnings are a bit below the street estimates because once again a decline coming in, but the major decline is actually on a YOY basis, but sequentially if we see that the numbers are not that bad, because if we talk about the revenue, definitely yes, that has come in below the street estimates. The street was expecting a number close to 1700 crores. What the company has clocked in is 1224 crores, while the EBITDA was expected over 200 crores. 187 crores is what the company has reported, and the margin, if we talk about, then 17%, around that number the street was penciling in. 15.3 is what the company has reported, but sequentially if you see, then there has been a jump, because like in Q1 FY24 the number was around 14.1%. This time the company reported 15.3%, and this was majorly because of the ARV segment, because last time the company guided that they are expecting an improved trend on that particular front. And lastly, onto the profit figure, a bit of a disappointment coming in, because around 50 crores is what the street was expecting in, and 37 crores is what the company has reported. Key to watch actually this time will be the sales outlook, because interestingly in Q1 the company did retain its FY24 sales outlook for CDMO as well as their generics, and in the bio segment they were expecting ramp up of the new capacity. So the key to watch will definitely be the sales outlook, because FY24 is what they have retained. They did give a positive guidance for the upcoming time. So a bit more details awaited from Loris Lab, but the first card is not that disappointing, because sequentially we are definitely seeing an improvement.
Okay, so that explains the mystery on why such a sharp decline in the PAT and the market reaction the way it is, about just about breaking into the green as we speak right now for Loris Labs. That's the one in trade for you. In the meantime, let's address some of the other movers. MCX, after that a bit of an aberration that we had last week, it's back to its gaining ways. And then, of course, it's really the private banks, Kunal, today. Besides that, really nothing. Kotak, IndusInd, HDFC Bank, ICICI Bank, they're the only resilient ones amidst the large caps. But does it seem like a convincing move?
No, I think frankly it's a nothing kind of a market day today, because when you look at the larger cap banking names, it's just offsetting the correction which is happening to the mid cap in the market. Today's day I think is more towards selling across mid caps and small caps, and the ones which have been rising up higher. I think if I'm not wrong, even the Nifty mid cap index is now for the first time come back towards its 50-day moving average. This is after I think a gap of more than 5 or 6 months for the Nifty mid cap index. So I think that's where the markets could get a bit more jittery. You may probably see days like today for the next couple of days where you may see the market breadth a bit more deteriorated, but the index still a lot more stable, because I think majority of the selling in the larger cap names I think seems to be behind us. So maybe they may not be incremental selling, but these stocks may just about be more sideways. So that could offset the losses which could probably be happening in the mid cap names.
Okay. I want to just pick up on ITC and Unilever as well and tell you how those stocks are panning out, because they're surely under pressure. In fact, ITC is the biggest drag on the index right now. A lot of brokerages have liked the numbers. They're saying the high earnings growth phase, while it may be behind us, but that doesn't make them bearish on the stock by any standards. Having said that, you've seen a little bit of a move down on ITC today, which is around that 438 odd level. And that's a similar case with the Unilever as well. In fact, just bring up that stock price as well for you and show you how that is currently panning out. Because brokerages believe the new CEO strategy is pretty much in the right direction, but earnings downgrade cycle and valuation leaves limited upside for Unilever. That is what brokerages tend to believe. Mayuresh Joshi as well joins in on the show right now. Mayuresh, hi, afternoon. What was your takeaway from Nestle, ITC and Unilever's performance?
Afternoon, Aisha. Obviously, I think the volume growth that was anticipated by the markets, volume growth definitely has come a tad lower. both for HUL and Nestle as well. 2% for HUL, Nestle also 4 and 4.5%, a tad lower than what the street was probably believing in. But it was largely a combination of two factors, Ayesha. One, the commentary surrounding rural discretionary spending expected to come back in a very moderate fashion. A large part of the analysts were believing in a very strong rural recovery in the second half, which obviously gives a huge impetus to FMCG players, both in terms of their volume and value growth. And if it's a moderate recovery, the expectations in terms of significant volume growth gets pushed back probably to the first half of the next financial year. Having said that, the kind of ad spend and the increases in ad spends by HUL, almost 11 odd percent, they will have to ramp up their ad spends. A lot of these FMCG companies, if they need to push their products through and their SKUs across price points in different markets and in different geographies as well, to probably ensure that volume stroke value growth happens at a reasonable pace. Having said that, valuations are again not too cheap for the space and within the space for HUL and Nestle. And therefore, I think the stocks might just go into a deep time and price-wise correction, both as we see it. ITC, reasonable set of numbers as far as most of their business segments are concerned. Again, the underlying issue in terms of how cigarette volume growth will be in the next few quarters is going to be a very key facet to be watched out for. Paperboards should bounce back in the second half in terms of expectations of demand coming back strongly and expectations of price increases taking margins and protecting them as well. Hotel business, agri-business expected to do well in the second half as well. So ITC, relatively better placed, both from a number and a structural perspective as far as the next few quarters are concerned within the FMCG space.
Okay, commentary coming in from Laurus Labs right now. They're saying that the continued focus on growth capex is going to continue in the CDMO division. By the way, the stock is lifted up over 3% from the session lows. FY24 is going to be a year of consolidation. That's the outlook that's they've projected. The stock already is now spiking up more than 400 rupees. Core growth rebounding on healthy demand environment in both the API as well as the FDF business. That's the commentary coming in from Laurus Labs. But just getting back to the FMCG names, Naresh, do you also believe there could be some more pressure for the likes of a Unilever, ITC, and for that matter, even a Nestle? And if so be the case, is this dip to be bought into just yet?
So one has to be selective here in terms of the stock selection. So HUL has been sideways for the longest time. ITC was a huge outperformer in this last 2 years. But names like Nestle India has broken out into new all-time highs, looks promising. A Tata Consumer, which has clearly shown leadership, that looks interesting in the FMCG pack. Then you have Britannia, which has gone through a sideways consolidation, which could take a jump up. Same is the case with the Colgate, which is making new 52-week highs. So it seems like the leadership has changed from HUL ITC to the other names. So the view is to look out for dips in a Nestle, a Britannia, a Tata Consumer, rather than a dip in HUL to buy.
Lotus. That's what everybody's saying. 406 rupees for Lotus. These are con call highlights. H2 priorities include higher capacity utilization across network to support growth acceleration. Markets are liking whatever I think they're indicating. And that spike, it was like a big spike in the last 10-15 minutes of trade, is reminiscent of what the numbers are. Muresh, do you track Lotus?
Yes, I do.
Muresh, there are very few things you don't track. I've realized over the years. How do you keep up, man?
I think God's grace and hopefully I think interacting with all of you keeps me on my toes.
So you read over the weekend also?
Yes, I do.
Come on, yaar. What cricket match? Do something else over the weekend. I had this habit of reading numbers over the weekend. I said, I'm not doing it now. Okay, Lotus now.
No, so as far as Lotus is concerned, I think two things happening here. If you go in terms of what the management commentary was a few quarters back, obviously the kind of pressures that they've seen, both product-wise in their formulation synthesis business and the biologics business as well, that has meaningfully now got played out. They were expecting a second half recovery to probably come through. and therefore sequentially the numbers are a tad bit better as the street was expecting. I think 2-3 things here, Nikunj. One, I think in expectations of their custom synthesis business, the CS business as we know, and the expectations in terms of the NCE drug substances. They are having dedicated resources towards that, as I've been reading through their transcripts. So this is one element that can continue doing well and expected to do well in the next few years. There is expectation of gradual traction in their formulations business, and with the total reactor capacity for the API plant expected to go up, both the APIs and biologics can be additional support units as far as earnings are concerned. So I think Laurus is very interestingly placed within the pharma universe. We probably remain optimistic. A little bit of price strength is what will make us even more sanguine on the stock. And any positive management commentary, I think, will give boost to a lot of investors who are there and stuck with Laurus for a moment.
What do you make of the news in IGL, Mayuresh? How detrimental that could be?
So on one hand, Nikunj, I think the expectation is to take the part of natural gas portfolio in the overall economy from 6 to 15%. So I think more and more geographical areas will obviously get added on. On the other hand, what has probably happened in Delhi, I think we've been hearing about this time and again, but if this gets implemented in the coming year, the expectations for IGL, because they derive around 15% in terms of CNG sales, specifically from Noida and the NCR region. And it's impossible for one to presume that the entire 15% will go up. Even if the entire 15% probably goes off, the kind of hit that can come through in terms of both the EPS and in terms of cash flows onto their balance sheet can be anywhere to the tune of 300 to 400 odd crores. That is what the back of the envelope calculations is saying. The kind of correction that the stock has probably witnessed is far more in terms of the knee-jerk reaction that the market is probably meeting out to the stock. So even if one assumes that entire 15% to go off, which I don't believe and think so, and the new geographical areas not ramping up to a certain extent, yes, numbers will come off, and probably the numbers which have come off, the stock correction has probably indicated that. But with this news, obviously a sentimental impact onto the stock.
Okay, those are a couple of ideas coming in there on IGL, which, by the way, of course, is really taking it, sharply on the chin right now. And I think it's the biggest fall that it has seen since COVID times. I think it's fallen about 15% in the last just 2 odd trading sessions. Kunal, a big breakdown on the stock, and I'm guessing you would see a follow-through selling as well, right?
Well, the follow-through selling has already come. The stock, I think day before yesterday also we were discussing, and I mentioned specifically that these are the kind of stocks which we typically avoid to trade because, just 3 days back, the stock was at 490 levels, which was a swing high for IGL. And now the stock is almost on the verge of breaking below the 400 levels, which could again be a major swing low for the stock, almost a 8 or 9 month swing low for IGL. So these are the kind of stocks which we typically avoid. Tomorrow you may see a bounce for the stock, and it may come back towards 410, 415 mark before it gets into another round of selling pressure. So completely avoid.
Okay. And in case you're wondering why this steep fall in IGL, the aggregator policy is now mandating EVs approved by the Delhi Chief Minister himself and a faster adoption of EVs in the National Capital Region, where IGL is a dominant player. So you are seeing a big fall. By the way, just to break it down for our viewers, what it really implies is it entails about 5% EVs in the fleet of the likes of an Uber, Ola in about 6 months' time, 50% EVs in 3 years, and 100% in the next 5 years. So that's really going to weigh in and eat up into the business of IGL for sure. And a complete electric conversion of all commercial vehicle categories by calendar year 2030. Fleet operators will need to get a new license within a span of next 90 days itself. So yes, entailing a faster adoption of EVs in Delhi after CNG market and IGL as well. So that's why the stock is facing the heat the way it is. In the meantime, while nothing really is happening within the large caps, I can only, recount pressure points. That's, of course, the likes of ITC, Unilever. These are the numbers which are these are the stocks which are weighing heavy on the markets. Metals as well, JSW, Hindalco, Tata Steel, some of the pharma names like a Divi, Cipla as well, under pressure as we speak right now. In the meantime, JSW Steel numbers as well, since we were on the subject of some of the metal names. The numbers will just come up for you on your screens. The PAR at 2760.
a little bit higher than the ET Now estimates, largely in line. We were penciling in a figure of roughly around 2,500 odd crore rupees for JSW Steel. We will just shortly get in Ashesha as well and try and stack up as to how they match up with what the ET Now poll was actually penciling in for JSW Steel, because we were anticipating the PAT, like I said, to come in around 2497 odd crore rupees. Realizations, we're expecting a fall of about 2 to 4% on a sequential basis, owing to lower steel prices in the second quarter. Remember, the average steel prices fell about 2 to 5% sequentially and about 5 to 12% on a year-on-year basis. So that's going to get reflected in JSW Steel's performance as well. Raw material costs also declined in the second quarter, so that's another factor to look out for. What they have to say about RM pricing outlook, the commentary on FY24 production, the sales guidance, all of that is something that we're going to be looking out for. But in terms of revenue, we are expecting a flattish performance. In fact, a mild dip on a sequential basis. We're expecting the revenues to come in at 42,133 crore rupees. 44,000 is what they've actually delivered. So that's a little bit higher than what we were penciling in. And yeah, in terms of margins, the 17% figure is what we're working with. You're seeing a bit of a recovery play out for JSW Steel.
These are, not bad numbers, Aisha. I mean, the new capacity addition and all the other factors have kicked in. Now, the point is that the quarter gone by was not a very strong quarter because of high coke prices, China demand not filtering in. But being the converter they are in, I mean, we are looking at huge, it's not a huge uptick in terms of profitability. But what really matters is that directionally, I mean, you're staring at a company which almost now has a 10,000 crore consolidated PAT. And if large part of your capex is over, then this could be a very different company in terms of generating cash flows and where things could move in terms of where the business is headed. So JSW Steel, if you frankly ask me, we don't realize it, and it could be one of the rare steel companies which has given you returns like an FMCG company. Let's look at it. 10-year return, 12-year return, 15-year return, whatever our producer can punch in fast. You'll actually see a big wave of compounding which actually has happened in JSW Steel. Let's look at it. PAT, there you go. 10 times. Thank you, sir. Murray Joshi, who would have thought a steel company in last 10 years would have given you a 9x return?
No, I think domestic steel companies are still holding out. I think I completely agree in terms of your thesis. The expectations that are now coming off is that a large part of the capex is largely behind us. I think some part of the capex is going to get carried forward in this financial year and the first half of the next, but the bulk of that capex is probably behind us. And with the expansions that are probably happening at its respective plants and the backward integration operations thereof as well, you're probably going to see a better EBITDA number on an absolute basis and on an EBITDA per ton that JSW Steel is going to produce. Again, I think it's largely a cyclical industry. We all know that, but a large element in terms of the infrastructure spending that is still expected to come through from the government side. I think that will reflect in better numbers for at least these domestic steel companies, where a lot of consumption might happen on local sources. And as prices recover on the LME, with China demand expected to come back in the next financial year, I think even the top line growth in terms of realizations for a lot of these ferrous players will continue to gain traction in the next year and a half as well. So yeah, I think domestic steel companies like JSW Steel can continue.
Right. Maresh, any stock or sector ideas that you're working with right now? Kunal was pointing out that from last month to now, we've at best just moved around in 100, 150 odd point band on the index, and even the small and mid cap indexes have not done a whole lot on a month to date basis, that is, or rather on a 1 month basis. Just wanted to understand, what are your biases both within the large caps as well as small and mid caps?
So cement and road construction companies, Aisha, I think they remain probably on our buy watch list. Within the large names, again, Ultratech is something that we continue to prefer at Marketsmith India. Large player, national presence, expectations in terms of carrying out the leverage capacities quite well. And again, I think not too much of debt onto its balance sheet as well. Within the same universe, in the mid-cap universe, Dalmia Bharat remains on a global focus list. Decent set of numbers that the company posted, an EBITDA of 955. And a small company in the Northeast, Star Cement, is also something that we like. They're expanding both their grinding and clinker capacity in the Northeast. zero debt company at the end of the day. And expectations in terms of reasonable amount of volume and value growth should suffice strong earnings growth for players within the cement space. Road construction company is also very interestingly placed. I think the acceleration in a lot of infrastructure projects, and specifically road projects to be particular, is expected to continue in the next few years. A few of the lesser leverage companies like a KNR Construction, PNC Infratech, stay on our buy watch list at Marketsmith India on two counts. One, I think the kind of equity inflows into their existing EPC and HAM book is very, very minimal, and their existing cash flow should suffice for that. On top of that, minimal or no leverage or negligible leverage onto their books, which means as improvement happens in terms of execution and with better IRRs coming through for most projects that they are executing, I think they will remain in a key focal area in the next few quarters as far as earnings growth is concerned. So I think a few of these pockets look very, very interesting.
Right. Okay, Mayuresh, great to have you on the show. Thanks as always for taking the time out and joining in. Let's get in some, closing strategies as well from our experts, or for that matter, BTST trades. Kunal, anything?
So Escorts is something which I'll go for a contra buy at current levels. The stock has come back towards 3,300 approximately. So would go for a buy, targets of 3,400, stop loss at 3,180. And Dixon Tech is the other stock which I would suggest as a buy, 5750 as a target on the upside, stop loss at 5,375.
Okay, Naresh, let's have your list too.
So first would be a buy on IndusInd Bank, closer to a new 52 high, stop loss at 1450, target price of 1520. Second would be a sell on Polycab, which has created a topping out pattern, stop loss at 5270, target price of 5150.
Okay, let's begin winding up for the week then. While for the week, we've had a lot of news flow to digest, and especially given the global context, not done bad. 19,500 is what we've managed to cling on to. We're closing just about mildly soft in an otherwise a weak global setup. The key pressure points today, of course, have been some of the FMCG names. ITC has cracked over 2.5% in the futures. Unilever, some of the metal names like a JSW, Hindalco, Tata Steel have all been laggards today. L&T, SBI, Reliance Industries, the blue chips as well have not participated in the trading session. But nonetheless, a Kotak Bank, IndusInd, HDFC Bank, Nestle have performed. So they are the ones which have really provided that cushion to the index. Along with that, of course, TCS also managed to hold out in the green, as did IndusInd Bank as well. From within the broader end of the market, also there were key pressure points. We were just flagging off the gas stocks. So IGL, MGL cracked pretty hard in trade. Tatacom, after its numbers, was down about 4%. Emphasis, again, an earnings reaction there. Havells also post its numbers. 5% is the crack that you had on that stock. But then MCX, UBL, Muthoot Finance, Delta Corp, Berger Paints, these are all stocks which were some significant movers today. But that's pretty much it on this edition of Closing Trades. We'll wind it up right here, and we'll see you again with the market action on Monday morning.
पानी से भरी बाल्टी जो जल्दी ऊपर लाए